Prashant, you're joined in this conversation about Yes Bank's financial results, which came, of course, on Friday. The announcement was, followed by a lot of analysis by analysts as well as the press with respect to the profitability numbers, specifically at Yes Bank. For the Jan-March quarter, the bank has reported a larger net loss of about 3,788 crore. And this large net loss, of course, has come largely on the back of higher provisionings by the bank against some of the bad loans that it has seen on its book. We are joined in this conversation with Mr. Prashant Kumar, the MD and CEO of Yes Bank. Mr. Kumar, welcome to this conversation. Let me first quickly start with the profitability number, because obviously that is something that a lot of people are watching. Last year in March 2020, when Yes Bank was going through a process of reconstruction, a similar net loss figure had been reported, and now a year later we're back to that figure. If you can just tell us what exactly is so different from March 2020 till March 2021.
I think, Vishi, if we see from a different perspective, on the operating profit side, bank has seen a growth of 42% growth in the operating profit. And despite first 6 months of the year was washed out because of the pandemic. So significant improvement and growth in the operating profit. Only thing was that we were having two options, either to take the provisioning call in the current year, or we take it to the next year earning also. So we have taken a call, it's a hard call, that maybe it would result into a loss, but it would be better if we take this provisioning upfront, and going forward the earnings should not be impacted due to the credit cost of the legacy book. So I think we have taken this call, and that is how optically it is being seen as a loss in the fourth quarter. But otherwise, it's only because of the provisioning call which the bank has taken.
Okay. Let me come to a little more granular figures, especially on the asset quality front, because of course that is directly linked to the provisioning figure. This year, you've seen, or at least in the fourth quarter, you've seen a large inflow of slippages, about 12,000 odd crore. About 8,000, you said you had revealed last week, 8,200 roughly crore worth of bad loans came because the Supreme Court had lifted that bar on asset classification in March, and therefore in the March quarter, all of those numbers came together. But still, at an 8,000 crore slippages number, sir, I understand fully that there is COVID in play, and therefore, there is going to be elevated slippages. But still, it seems for Yes Bank that figure is significantly larger than what the industry is reporting.
So unfortunately, Vishi, in Yes Bank, we had a large exposure on some of those sectors which have been impacted by COVID very badly. Especially, I would like to name three sectors. One is on the real estate, developer loans. Second is in terms of the hospitality industry, the hotels and others. And the third one is anything which is related to tours and travels. So I think these three sectors have been badly impacted, and we were having a disproportionate, exposure to these sectors, which has gone back. And 8,000 crore slippage was up to December, but could not be recognized because of the Supreme Court embargo. And another 4,000 crore slippage happened during the March quarter. So that's how we are seeing a slippage of 12,000 crores for the entire year. Actually, everything was precipitated in the fourth quarter because after the Supreme Court.
Okay. Keeping in mind the nature of this pandemic, now we are in a situation where it hasn't really gone away, impact-wise. There is now the second wave that is rising. Many states are putting in localized lockdowns. There are severe restrictions of movement in a number of states. I'm trying to understand the recoverability of these accounts which have already gone into NPA, and probably some of those accounts which are not yet NPA but are still stressed.
So on the two things, I think what we are seeing that there are restrictions on movement, but as compared to previous year, I think we are not seeing that kind of restriction. So manufacturing activities, movement of people, movement of goods, that is happening. And if you just recall, April GST number is an all-time record. And whereas the 15 days in April, there have been a restriction. So what we are seeing because of pandemic, there is a severity, but I think the time span of the pandemic would be comparatively shorter as compared to last year. Another part is that we also now have the vaccines, which were totally missing last year. So I think once we would be able to take the vaccination part also for most of our population, and we have also seen in terms of the economic impact, I think going forward, the negative impact on the economy would not be that much.
Okay. I was going through some of the analysis that analysts have put out over the weekend. They seem to suggest that the pain that is coming from the COVID-19, earlier the management had expected about a 7 to 8% of stressed asset ratio, which has now risen to 17 to 18%. Considering not just the restructuring, but also say SMA1 and SMA2, there is also accounts which were already stressed before COVID hit. So all of that put together, and because of COVID, things have gotten worse. So all of those put together, the stress ratio outside of NPA would be about 17-18%. I'm just trying to understand, sir. If there is elevated stress, now you are already looking at a situation where the bank is heavily provided. Is there, and of course, to that effect, capital has also reduced during this period. To that effect, is there room for further provisioning for the bank? How much of an impact would that see on the profitability as well as on the capital adequacy?
If we see our current SMA1 and SMA2, it was around 19,000 at the end of December. This 19,000 has come down to 13,000. And out of 13,000, also 2,200, there are cases where restructuring was invoked, but now implementation would be done during the current quarter. Already 10% provision as required by regulators have already been made, so there is no need. Another 2,000 crores of this SMA 1 and 2 has already been upgraded. So actually we are left with 10,000 crores of SMA 1 and 2. We have also seen the past behavior of these accounts. These accounts, even in the good times, were always in SMA 1 and 2. Because like as a credit discipline or as a habit, they were always servicing the interest after a lag. So we are not seeing any impact coming from this SMA 1 and 2. But because of pandemic, we need to be very, very cautious. Our estimate is that in worst case scenario, our slippage would not be more than 4 or 4,500 crores. And the credit cost of this slippage would be taken care by our recoveries. And the existing book is very well provided. So 79% on loan and 92% on investment. There is absolutely no need to make any additional provision on the existing.
Okay. During the fourth quarter, you reported higher recoveries than what you had seen throughout the year. As of FY21, for all 4 quarters, there's about 5,000 crore worth of cash recoveries. There's also some upgrades, but on the similar pattern, there's a high write-off ratio as well. Just in the fourth quarter, about 10,300 crore worth of write-offs have been reported. What I'm trying to understand from you is whether write-offs are going to be I'm not saying that it's a bad thing, but I'm saying that are write-offs going to be prioritized as a way to clean up the book, because it's easier to take them off the book rather than keeping them on and continuing to provide for them over years.
So our write-off is a pure technical write-off. It has no correlation with the probabilities of recoveries. So probability of recoveries in those accounts, whether they remain on the balance sheet or outside the balance sheet, it remains the same. Only from the perspective of balance sheet management, where the 100% provisions we have made over a period of time, we have done a technical write-off. So going forward also, I think from a balance sheet management perspective, if there would be like this possibility to write off some more accounts, and again a technical write-off, definitely we will do that. Because it is having some other implication. Your priority sector requirement is always on a gross book. So unnecessarily keeping those NPAs which are 100% provision would attract a higher amount of priority sector loans also. So I think just for a balance sheet management perspective, we have done a technical write-off. But going ahead, we don't see any need to increase the provisions on the existing loan. So that's why the possibility of further writing down on technical ground would not arise.
Okay. You already have a team of people working on the management of stressed assets at the bank. There was also talk of setting up a separate ARC where some of these assets can be transferred, and that can be focused on exclusively rather than uh, letting your credit team and your risk team get involved in these kind of activities. I, I'm trying to understand what would you say is a better way of handling things, because in a year of reconstruction, Yes Bank has reported recoveries and upgrades. So it's not like the only option is to take those loans off the book and transfer it to another entity.
So you are absolutely right. I think the recovery prospects within the bank or outside the bank, provided we have a controlling stake in that ARC, would be the same. But I think if we don't have a controlling stake, then the possibilities of recoveries may hamper outside. And that's why when we approach RBI for approval for setting up an ARC, it was with a controlling stake of 51%. Reserve Bank of India is of the view that if a bank is having a majority stake in a ARC, it's a conflict, and there may be a moral hazard also. So at this point of time, since the RBI has already set up an expert committee, which is going to see the entire framework around the ARC, we would wait for this, and once those guidelines would come, we would again approach for setting up of the ARC. And I would like to see this ARC not only as a vehicle for resolution of our own asset. I think this could be a good business opportunity for the bank because we are having that expertise available within the bank. So going forward, if it is not for our assets, but I think for the assets of the banking industry, we would like to pursue this as a business opportunity.
Okay. Coming to the regulator's point of view in this regard, I mean, it is right? I mean, there is a moral hazard if for a bank to own majority stake in an entity which claims to take the loans off the bank's book. I mean, net, there is really no benefit to the bank. I mean, apart from the fact that it has moved from one balance sheet to another balance sheet.
No, so there is an advantage in terms of optically, this would be good. Second, you free a lot of management bandwidth. So today, if you see, my 50% of my time is only for the resolution of the stress. Okay. So once this is set up, and basically why I'm saying there would not be moral hazard, because we are talking of a very transparent process of disposing of these assets, in which the other ARCs can also participate. So whosoever would offer a higher value, there the assets can be transferred. Controlling a stake would be more in terms of taking the resolution further. Because if the resolutions are done by an unconnected party, they don't feel that pain. And then the possibility of recoveries also comes down. So our thought process is that controlling a stake means that our people who understand the assets would also be involved in the recovery.
Okay. Okay. I'm sorry. I'm going to push you a little bit more on this point. This whole idea of creating another ARC. I mean, this is not something that Yes Bank has alone come up with. There's an industry body which is trying to see the creation of a bank. They're talking about a government guarantee which could help them provide less against these assets. So why not go for that? I mean, it seems that it helps. It would help in aggregation at least. Some of these accounts which you're talking about are spread across many banks, so it would make more sense to push it to that entity, right?
So first, like we don't know exactly what are the contours around that national ARC. That is one thing. Second thing, the aggregation itself would not resolve the things. It depends on the people who are going to handle this. So unless you understand the asset, it would take very long time for the recovery. And understanding asset itself would take 6 months to 9 months. So once you have those kind of experts who are there, then they understand the asset and then they will go for recovery. So that's why we feel that instead of, say, transferring to such a large entity, either we do it within the bank or maybe within a ARC where our people would be involved in the resolution.
Okay. So you're okay with a 49% stake then with the ARC?
No, so that depends. That depends. I am saying in terms of the management control, that we would definitely like to have. Otherwise, this would be just like any other ARC.
Understood. Okay. Let me pivot to the growth side at Yes Bank. Now, of course, in the last 1 year, a lot of time has gone into managing the balance sheet and trying to come out of the problems of the past. So obviously, the growth has gotten impacted in the last 12 months or so. Trying to get a sense from you, you've already guided to about a 15% credit growth on your book. You've also said your deposit growth is going to be significantly higher than your credit growth in the coming year. What I'm trying to understand is we are in a very uncertain time, at least as of now, at least during the first quarter of this financial year. Uncertain in the sense that we don't know when things will turn, if at all, during this financial year. At this time, does a 15% loan growth make sense?
No, absolutely. And why we are confident about it? In the last year, like first 6 months, you take it out, we could have a 23% growth on the retail loans. On the SME also, we have disbursed almost 10,000 crores of new loans, where the growth is yet to come in the books. Why it is not being shown as a growth in our loan book? Because of two reasons. One is the additional provisions which we have made. Because of that, the net loan book comes down. Second, in terms of we pursued a strategy of debulking and de-risking the corporate. So that part is also now over. So going forward, we will be whatever disbursement we will do on the corporate would also result into the growth on the corporate book, and retail and MSME would continue to have this kind of growth. So our target is next 3 years, the retail book, we would double. So already retail proportion has gone up from 24% to 30%. And retail and MSME mix has also improved from 44 to 51. So we will take it to 60%.
Okay. So 60% of retail and MSME on the book.
Yeah.
Is this largely a secured focus loan book or is unsecured part of the strategy, or is it going to lead? Because obviously that portion of the book tends to go faster than your secured portfolio.
So we are very well diversified on the retail side, and our unsecured portion is only 15%. And if we see our book like retail book, not more than 15% share in any of the things. So we give the secured business loans, we are in the car loan, we are in the commercial vehicles, we are in the personal loans, we are in the equipment finance. In a single portfolio, we don't have more than 15% exposure of the total. And the unsecured part is only 15%. And even during the last year, which was very bad year, we have not seen the delinquencies from our unsecured portfolio. So overall, if you see GNPA number on the retail is less than 3, which is in line with the best of the industry, and net NPA is less than 1%.
Okay. What could be the risk of growing retail aggressively in a market where already there are people who have an established retail franchise? Some of them have pulled back. Like for example, the HDFC Bank, the largest retail end of the market, they've sort of pulled back on their retail growth. But some of the others, ICICI, SBI, they're all really pushing forward with retail. In this kind of a market, what could be the risk? Because the question then remains whether smaller lenders will end up having to underwrite weaker quality loans.
So it depends on the size of the book. So our size of retail book is 50,000. On a 50,000 crores of book size, growing at 20% is not a difficult thing. Whereas if you are having a say book size of 5 lakh crores, then 20% growth is very, very difficult. Second part, if you see that some of the large banks, they are predominantly focused on the home loans. Whereas in our case, we are mostly on the affordable home loans.
Okay.
So home loan is one sector where there is a lot of competition and there is a pricing competition is also there, which is not a significant part of our strategy.
Okay. As part of your disclosures during the results, you've also said that by FY24, you want to double your deposit base, triple your customer base. I mean, what I'm trying to get at is, yes, there is reconstruction, there is improvement. Is getting trust of a larger pool of people a challenge for Yes Bank?
So I just give you some data about it. in best of the time, Yes Bank was adding, say, 30,000, 35,000 customers a month on the CASA side. Today, we are adding almost 85,000 to 90,000 new customers while opening their current account and saving bank.
This per month?
Per month. So last quarter, if you see, we have added almost 265,000 new depositors on the CASA side. This journey continues, and today we are opening 80% of our new accounts on the digital mode. So there is a significant reduction in the cost. There is a lot of convenience for customer, and there is no need for either a customer to come to the branch or our employee has to go to the customer. So I think this journey would continue. And our focus is on adding large number of new customers on the CASA side. And we are continuously reducing our rate of interest on deposit also. So our cost of deposit, if you see, like last 1 year, has come down by 50 basis points. So this journey continues. And we are quite hopeful, and that we are seeing every month in terms of deposit acquisition.
How much would you attribute this to, say, support from larger lenders like SBI that continues for Yes Bank?
In terms of deposit?
No, yeah, I mean, in terms of depositor trust, because SBI still invested in Yes Bank.
In terms of deposit, if you see our CDs, they are just 7,000 crores, and actually the amount of CDs has come down. So we are not dependent on any of the lenders for CD. Second thing, in terms of the trust factor, which SBI, definitely that would play. Okay. Once like State Bank of India is having the majority stake, or not majority, but the larger stake of 30%, it definitely gives a confidence to the depositor.
Yeah, I'm saying that eventually that is going to come off, right? I mean, at some point SBI will invest or at least sell its holdings in the bank.
So as per the reconstruction scheme, State Bank of India would be keeping 26%. They have to keep 26% yes. By end of FY23.
Correct.
And after that, I think that would be a call which the SBI would take depending on how much return they make or what they would like to do. But I think this 1 year or 2 years is more than enough to build that kind of trust.
Okay. So you're expecting by that time you would have built enough momentum that wouldn't be a factor in play.
Absolutely.
Okay, sir. Last couple of questions, I just wanted to get a sense, there is a lot of interest in Yes Bank's financial performance, apart from the history that is unfortunately taking place at the bank. But there's also a lot of interest in your vision and your attempts at turning around the bank. What would you say has been the most challenging aspect of the last 12 months as far as you as the new CEO of the bank is concerned?
So I think the challenge was more in terms of that you are taking command of a bank, which has been put under reconstruction. And reconstruction also at a time where was almost like if the decision of reconstruction would have been delayed even by 2 weeks or 3 weeks, then subsequently there was a lockdown. If we really don't know whether we would be able to survive. So it means we have taken command of the bank at a point of time when it was about to collapse. Taking from that time, and if the whole economic activities are stopped because of the pandemic, then taking bank to this level is definitely very challenging. But I think most of the things we have been able to take care in terms of deposit growth, in terms of capital, in terms of adding new customers, in terms of growing on the retail advances, in terms of generating a very decent operating profit, 42% growth, and also 5,000 crores of cash recovery. Only thing is now going ahead, we just need to ensure that our credit cost on account of any slippage is offset by the recoveries. And then whatever is the operating profit is available for the distribution to our investors. So I think we are absolutely on track, and COVID is something which I think I would not like to hazard any guess, but hopefully with the vaccination, with the preparedness, I think we would be much better at the world. And I think with the growth in the economy, because all our projections would also factor into the GDP growth forecast. If the GDP forecast is around say 10 or something, I think we are absolutely on our forecast. But if there is any impact, I think it would be beyond the control of anyone.
All right, we'll leave it at that, Mr. Kumar. Thank you so much for joining us, and I hope you and your family are all safe and healthy going in and stay that way for a while. Thank you so much for joining us, and thank you for watching this interview with Mr. Prashant Kumar, MD and CEO of Yes Bank.
Thank you so much. All the very best.